Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ADAMAS Trust INC quarterly report. ADAMAS Trust Inc. offers a diverse range of businesses and services, including acquiring mortgage-related assets, investing in single-family and multi-family residential properties, financing residential loans, such as business purpose loans and agency RMBS managing mortgage-backed securities, including non-agency RMBS and CMBS, providing structured investments in multifamily properties, owning and managing single-family rental properties, offering strategic investments in mortgage and credit-related assets. The stock price of ADAMAS Trust Inc. has increased by over 34% within the past year, driven by a series of positive news events. The company's rebranding to ADAMAS Trust Inc. in September 2025 marked a significant shift towards a broader strategic vision, emphasizing strength and durability. Strong third-quarter results for 2025, with net income and earnings per share increasing significantly, further boosted investor confidence. The company's sustained dividend growth, with an increase of $0.23 per share, is also a positive signal for investors. Additionally, ADAMAS Trust expanded its investment portfolio by $1.8 billion in the third quarter of 2025, reaching a total of $10.4 billion. Strategic transactions and capital management efforts, including securitizations and note issuances, have further solidified the company's investment strategy. These positive developments have contributed to ADAMAS Trust's stock price increase, with investors responding favorably to the company's growth prospects and strategic vision. The primary drivers of revenue growth for the company are multifaceted. Net interest income increased by 12% in the 3 months ended September 30, 2025, while proceeds from sales and repayments of residential loans held for sale contributed significantly to revenue growth. Principal paydowns received on investment securities also played a crucial role. Sales growth was another key driver, with a 3% increase in revenue compared to the same period in 2024. Mortgage banking activities, servicing fee income, and realized gains from sales of properties further boosted revenue. The company's expansion of its investment portfolio, including purchases of agency RMBS and an increase in the fair value of investment securities, also contributed to revenue growth. On the other hand, the primary drivers of revenue decline were largely related to losses on deconsolidation of joint venture equity investments and a decreasing gain on sale of real estate, sales of U.S. Treasury securities and principal paydowns of agency RMBS also led to a decline in revenue. Net income and profit margins. A shift in favor of the company's net income has undergone significant changes between 2024 and 2025. In Q3 2025, net income increased by $292 to $32,702, while year-to-date, YTD, 2025 saw a substantial increase of $121,458 to $59,501. This represents a remarkable turnaround from the previous year's net loss of -$61,957. Profit margins have also experienced changes, albeit less dramatic. The operating profit margin decreased slightly from 50.1% in Q3 2024 to 49.2% in Q3 2025. However, the net income margin has shown a more substantial improvement, increasing from -97.1% in YTD 2024 to 73.2% in YTD 2025. The reasons behind these changes are multifaceted. The company's repositioning of its investment portfolio has led to an increase in recurring income and improved liquidity. Additionally, the decrease in unrealized losses and the rise in realized gains have contributed to this shift. Furthermore, investments in agency RMBS, business purpose loans, and a consolidated SLST subordinated bond have generated additional interest income. Overall, these changes indicate that the company has successfully navigated its financial challenges and is now experiencing growth and improvement in its net income and profit margins. The company is indeed generating positive operating cash flow, a significant indicator of its financial health and stability. The data points on pages 15, 117, and 188 all confirm this trend, with the operating cash flow values ranging from $71,959 to $73,531 million in 2025. This consistent positivity suggests that the company is effectively managing its finances and generating sufficient cash to support its operations. The company's debt level and interest expenses have undergone significant changes. The total debt has increased from $60 million in 2024 to $215.5 million in 2025, primarily driven by the issuance of new senior notes. This increase is reflected in the adjusted interest expense, which rose by 47.8% to -$106,748 in 2025 compared to -$72,296 in 2024. However, it's worth noting that the company has managed its debt through various financial instruments such as interest rate swaps and TBAs. Despite this, the net interest income loss increased by 48.6% to $42,752 in 2025, indicating a positive trend. The decrease in mortgage payable on real estate and the reduction in leverage ratios suggest that the company is taking steps to manage its debt effectively. Overall, while the company's debt level has increased significantly, the interest expenses have also risen due to higher interest rates. However, the net interest income loss has shown a positive trend, indicating that the company is managing its debt and interest expenses effectively. The management is signaling a cautious yet optimistic outlook for the company. They are focusing on acquiring assets with less price sensitivity to credit deterioration, managing interest rate risk through hedging instruments, and maintaining liquidity through various financing arrangements. While they acknowledge potential credit risk due to inflationary pressures and economic uncertainty, they are taking steps to mitigate this risk through due diligence and purchasing credit default swaps. The company's strategy is centered around investing in the residential housing sector, with a focus on selecting servicers with expertise to minimize losses and maximize returns. They also intend to make distributions to stockholders to comply with REIT requirements and minimize taxes. Overall, management appears to be prioritizing risk management and liquidity preservation while pursuing growth opportunities in the residential housing sector. Acquisitions and divestitures overview. The company has made numerous acquisitions and divestitures in recent years, reflecting its strategic focus on expanding its portfolio and optimizing its investments. Acquisitions. Key acquisitions include the purchase of constructive, Treasury-backed securities, U.S. Treasury future contracts, gold future contracts, and various financial instruments such as credit default swap index contracts and equity index put options. The company has also acquired residential loan repurchase agreements, sustainable non-mark-to-market financing arrangements, and expanded its agency RMBS portfolio through mark-to-market repurchase agreement financing. Additionally, the company has made strategic investments in non-agency RMBS, CMBS and ABS, mezzanine lending, joint venture equity, business purpose loans, and multifamily properties. Divestitures. The company has also engaged in divestitures, including disposing of assets from its portfolio to pursue new investment opportunities. This includes generating higher portfolio turnover to acquire assets with less price sensitivity to credit deterioration. The potential public offerings of Fannie Mae and Freddie Mac are also mentioned as a means of exiting conservatorship. The company's financial summary reveals a history of dividend payments. Specifically, it is noted that dividends were paid in the amount of $35,891 as of September 30, 2025, page 57. Furthermore, quarterly cash dividends have been declared on preferred stock from January 2024 to September 2025, page 98. However, there is no mention of share buybacks. Concerns over inventory buildup and supply chain disruption loom large. The real estate market is facing a pressing issue: inventory buildup. As of August 2025, the total housing inventory has increased by 11.7% year-over-year, with an unsold supply sitting at 4.6 months. This surplus can lead to stagnation in sales and potentially impact the overall market. Furthermore, global trade disruptions and tariffs imposed on foreign goods pose a significant threat to supply chain stability. These external factors can disrupt the flow of essential materials and components, exacerbating existing inventory buildup concerns. As a result, it is crucial for stakeholders to address these issues promptly to mitigate their effects on the market. That concludes the financial summary for ADAMAS Trust INC. Feel free to comment below, and I will be happy to answer them when possible.